Welcome to another episode of Why Real Estate. I'm Layne Thompson, your host, and I look forward to sharing some important information regarding the Housing Affordability Index. A lot of the information, if not all of it, comes from the National Association of Realtors, and I think it's important that we understand what's happening in the market in relation to income, in relation to mortgage rates, and how that affects a buyer's capability to buy a home. Now, what is the Housing Affordability Index? Well, it is based on a 25% qualifying ratio for monthly housing expense to gross monthly income with a 20% down payment. Now, they have to have a baseline, right? A metric. Not everybody has 20%. Some people have more than 20% that they put down. But this is a great measurement tool that is used to be able to predict and tell us exactly what's happening with the housing market. To give you an example, and this I have data here back from 2020 through August of 2023. Okay, a little bit more information so you understand what it means. This index uses a value of 100% to represent the position of someone earning a population's median income. Okay, with values above 100 indicating that an item is more likely to be affordable, and with values less than 100, meaning that is less affordable, okay? And points below indicate that a median family below 100 may indicate that a family on a median income could struggle to be able to afford to buy a home or to support a mortgage in that area. While a value of 100 indicates that the typical family has exactly enough money to be able to afford a home. The historical data that National Association of Realtors use is essentially, it is clear that housing in the United States, for the most part, has always been affordable. Okay, and you'll find the data that I'm going to share with you, the different numbers. I want to explain this so that you understand why we see a slowdown in the market. Okay, even though, especially where we live here in Utah, I mean, we're short approximately 50,000 homes with the demand. But again, it's got to be affordable to be able to make sense. Major dips in the tend to coincide with periods of an overheated housing market. Examples of that would have been in the 1970s and 80s during the savings and loans crisis from 2005 to 2007, which became the precursor to the Great Recession that hit us in 2008. At those times, sometimes the affordability was below 100 points. But overall, the index is usually well above 100, again, based on the median income of the family in the United States. So here's some data, okay? I think it's important that we understand what's happening in our market. And back in the year 2020, the Housing Affordability Index reached 170. Okay, extremely affordable. Interest rates were low. There was enough inventory. In 2021, it hit 148. So you can start to see the slide with the rising interest rates, right? In 2022, still affordable at 108 was the Housing Affordable Index. Okay, now in regards to 2023, each month it's gone down. And we're sitting at, overall in the country, at 91.7. Now let's get a little bit more specific on the areas in the country, and we'll break it up by region: Northeast, Midwest, South, and West. The Northeast in August was 88.8. The Midwest was 119.7. Much more affordability out there, right? The South was at 93.2. And carrying or bringing the entire average down, which we're seeing out here in the West, from prices in Idaho dipping to Utah to California to Nevada, Housing Affordability Index is at 66.3. Okay, so it's not easy for everyone, but it is important to take this into context and to realize that it does ebb and flow with time, that the economy will come back. And for the year, in the West, it's at 77.3, and all three of the other areas and regions that I mentioned are well above 100 for the year so far. So we're currently at one of the lowest points in affordability, but expect that it will come back. maybe not as fast as you want if you're looking to buy a home, but trust that it'll come around, and that in time, you'll be able to afford if you can't right now. And there's also, this is a great time to discuss the number and amount of loan programs are out there, and how getting concessions from sellers who have to sell to help buy down your interest rate. As a matter of fact, it's more critical right now to be able to buy down the interest rate than it is, say, for example, on a $450,000 house. It may be better to offer the full price, but ask for $10,000 or $15,000 in concessions from the seller in order to get that interest rate lower, so your monthly payment can fit within those parameters that you need within your budget. Okay, that's more important than saying, hey, rather than pay $450,000, I just want them to sell me the house for $435,000. Well, at today's interest rates, your payment's going to be much higher than had you just taken the money or the concession to buy down the rate. Now, if you're buying with cash, who cares, right? That doesn't really affect you. You would probably go with the $435,000, no doubt, rather than asking for the $10,000 or the $15,000 in concessions from the seller. So anyways, a lot of data there. Reach out if you have questions. Grateful to share that with you. Thanks for watching, everyone.